Hello, everyone. Welcome to today's session. Let's get underway. Market conditions, we've shifted to mildly bearish as of yesterday. We'll see where we end up closing today. A little bit of a rally happening here today. And momentum has shifted back down into that middle hold range and also a breadth into that middle range as well. Sentiment still in the upper extreme range. So we're seeing some pullback here in momentum, seeing some pullback in sentiment, buy-sell ratio. We're also seeing an expansion there, seeing some widening here. That buy-sell ratio number, we've gone back down to, let's have a quick look here, 0.41. So we're less than 1, 0.99. We hadn't been less than 1. That's the first time. Let's see if it got down there right now, 0.58. A couple times less than 1, but that's a pretty decent move lower. And so we'll keep an eye on that, where this is potentially concerning as far as market tops. We're seeing sentiment pull back down through that halfway point, that 44.82, 50% line sitting right here as well, and want to keep an eye on that. If we also look at S&P 500 chart, a few things weakening happening here. We've got SPY. This is a price pattern that we're going to want to watch because we've got an area now where we've got this support that's happening here, but notice how it's kind of rounding off just a little bit. So now we're potentially getting lower highs. Okay, when you go from here to a higher high, and now as it's attempting to make a move back up, it's running into this resistance now right here. So we want to see where we end up closing in the next couple of days, because if we can't break back up above this area or this area, and we start to weaken, and then we potentially reverse back down and close below this support area or even back down to this one, that's okay. Still in that upper momentum zone and some retracement, but it just means more work in this current trend. If we could get a retracement back, hold around this 506 range and then move higher, but we're just getting, now we were at the upper end of this range. This bull market's been going on for quite some time now, and we want to be able to analyze this topping pattern, because we certainly know a couple things we know, and that is, number one, direction alerts. This 22, this bullish rank of 22.43, that's as high as this ever gets. Okay, so what does that mean? Is it going to go higher? Being as high as it ever gets in the last 14 years, I think this is as high as it's been, and maybe a little bit. I think it might have been to 23, 24, but this 22 is as high as it has been. So what that could mean is that we're going to get a reversal, or we're going to get just a consolidation phase, sideways phase, maybe an up, maybe a down. There's going to be lots of things that are happening here. We're also entering into a seasonal period of time where markets traditionally are weaker. April is usually a good month. May, you've heard of sell in May and go away. That's because we get into May and then we get into summer and things start to slow down a little bit there. If we take a look also at, this is really the main point to be paying attention to right now, and that's interest rates and bonds. So we're seeing on TLT, which is that 20-year bond, we're seeing it extreme to the downside now in this downturn trend. And now it's approaching the 618 level, 618 of our swing low point here and swing high point. That's a common reversal zone, this 50% 618, in a deeper retracement. For it to still be considered an uptrend and then a retracement and some support and then continue that uptrend, it's got to start holding up right here inside of this zone, this 50% 618 zone. Sorry, I had to almost sneeze there. And if it doesn't hold up here, then it could be interesting. It really could be interesting. Even this right now, if you think about what's happening right here with this TLT chart pattern, if we go out to 1 year, markets were at their lows right here. Okay, markets were at their lows with bonds, and then markets rallied, and they've been pausing and pulling back. Bonds have been moving back. The markets have not pulled back that drastically. Okay, so it's going to be interesting if bonds keep moving lower, and we keep getting high inflation type numbers, CPI numbers, price index type numbers are continuing high. Then there's a chance that the Fed won't be lowering interest rates. They'll just keep them where they're at and potentially even raising them. But the bond market's going to help us kind of see what the bond market is thinking about what the Fed's going to be doing. and vice versa. They're going to be playing off of each other right here. And so we're seeing in the shorter term, we're just seeing bonds not helping the story. Okay, this 1-year chart on SHY. So that, what the question is, which one is going to break? Which one is going to give? Okay, if bonds are moving lower and interest rates are back up to where they were and the market was at its bottom, well, look where the market is at right here with S&P 5. Oops, not that one. With S&P 500. Okay, so markets were here, bonds were almost where they were at right here, and the market is now right here. Yet interest rates have not really changed. Which is it going to be? Are equities going to retrace, or are bonds going to start to rally back up, or a combination of both? I think that the market is starting to get a little bit touchy when it comes to these inflation numbers, and they're not loving it, the fact that things are still elevated, and the Fed's not going to be able to have much control in managing or even bringing those interest rates down. I mentioned this last week, or it might have been on Tuesday, is interest rates of 5 to 7%, even 6.5 to 8.5%. Back in the 90s and early 2000s, that was pretty normal to have that. It was really 2009 and 10 where we got just all of this economic and banking crisis and the subprime issues and a lot of things happening. And then we get COVID. So interest rates were so low for so long, we just have gotten so used to it, versus the norm has probably been 5, 6, 7%. So this is just, the market may be like, okay, that the higher interest rates are the new norm. And they're not discounting the fact that they're not going to change. So the economy is still functioning, businesses are still functioning, interest rates have not hurt everything as bad as maybe anticipated. The market may be a little bit okay with higher interest rates right here. We'll see. That's why I say which one is going to give right here. We're going to get equities that move lower, or bonds that start to rally and interest rates moving lower, or do we get this stagflation scenario where nothing's moving, but we're stuck in a high interest rate environment with relatively flat growth? We're not there yet, but we'll see if that takes place. So those are kind of some macro perspectives. We also wanted to still talk about this bond yield curve. This is important in this discussion because that's all that's being talked about still. Okay, the short end of this yield curve, these shorter term bonds, it just has to come back down, and it's not happening. With the data that's starting to happen here as well, we're just not seeing any move in interest rates to the downside on the short end of the curve. And so we'll see. There just hasn't been any budge in that. Keep an eye on that one moving forward. Let's talk about sectors also here, because we're seeing a lot of red now across the board with these sectors. The only one we've got in an uptrend now is energy. Everything else is starting to move lower. It's either full on shifted into downtrends. Anytime we have this sell signal, it's a shift over into a downtrend, which means it's a higher probability of that being the sustainable trend versus it being just an uptrend, some support. Sometimes it does find some support and enough downtrend that it does turn red and give you a sell signal right here, maybe 1 or 2 or 3 bars, and then it rockets higher. That could certainly be the case. But in some cases, they're just in nasty downtrends. Real estate, let's take a look at that one here. I wanted to look at that on a 6-month time frame and see what's happening here. One of the things that starts to happen when we start to get some head fakes is this pattern right here, and that is we get the first retracement, we get an attempted rally, and it really is trying hard to break out. You do get some breakouts here, and so if we were looking at this chart pattern right here as a stock, in this case, as the ETF, and we're watching it, maybe we're watching it right here. Well, what do we have right here? We've got a nice buy confirmation bar in the momentum zone, high volume, breaking out above lots of resistance. That's a great buy signal. Okay, that is a buy signal. That's a trade that we would have taken probably with a stop loss right here. Okay, and in that case, we go a few days, move higher, kind of waffles here a little bit, floundering around, not moving, retesting the 236. It's breaking down. Our initial stop would have been right back down here. So we're still watching and then probably getting close. So now you're starting to get some downtrend signals as well. And then either an exit or a stop out on one of these days right here. Okay, so it certainly happens in markets as well. But this pattern, when a trend is starting to reverse after it's been in a nice uptrend and it comes down and it makes an attempt and it doesn't hold, that's what we want to see, because sometimes that we get that second one higher and we do get a blast off, whereas this becomes that head fake. We'll want to watch IYR and see if we get any support here, or if there's just continued weakness. IYR, because it's real estate, that one is going to be sensitive to what's happening in interest rates right now as well. Let's jump over and look at commodities, because that's kind of the hot place. Oil, big nice run up and a little bit of a retracement here, pulling back. Hasn't pulled back a whole lot, but it's just consolidating here after this big run up and this breakout of $78, $79, moving higher on USO. That'll be interesting to see if we get continued move in USO. SLV, which is silver, also moving higher. Gold, we know, is also moving higher. Those are the current real strong sustainable trends right now, and that is gold and oil. But they are commodities, and commodities don't do anything. They don't make anything. They don't produce revenue. They're just things. They're just stuff. And so it's demand and supply, and that's it. So if there's more demand than there is supply when it comes to commodities, it's going to go higher, and vice versa. If there's more supply than demand, it's going to go down in value. So right now there's just more demand for these commodities, and they're moving higher. And gold typically is a flight to safety. Gold typically is an asset that investors will move into if there's fear of, monetary issues, the U.S. economy, and maybe the U.S. dollar as well, or equities. And so you're seeing a big move here in gold, which is interesting as well, because if we were to go really on the real doomsday-ish perspective, there's some real doomsday talk out there of a pretty nasty blow up and bear market, and there always is, right? It's always, I think the truth tends to be somewhere in the middle, and I don't like to listen to too many voices. I just like to listen to the data. We'll just follow the price data and make our own decisions based on the price data. But it's always interesting to kind of get it to hear what's happening, because it's these big institutions, they've got to position themselves going forward as well, and it takes them some time to position. And so there may be money running into gold for some type of an economic slowdown or full-on recession. Typically, we do get a recession with an inverted yield curve and higher oil prices as well. So we've got inverted yield curve, higher oil prices. If you're a really, really conservative individual investor and dealing with volatility, or even the amount of time you have till you're using or needing your cash, make sure that you're positioning yourself in that case for some possible volatility and even some possible downturn right here in equities, and making sure your cash positions are where you want them to be. And it's about individual risk tolerance. It's about what you can stomach. It's about what you can understand. You don't want to be buying in things and holding things that you don't understand, because or at least understand the risk that's being associated with that trade. We talk about that all the time when we're talking about the amount of risk, the portfolio risk. We're going to enter a trade. What is our portfolio risk? We'll go through an example here as well. So that's really, let's look at, so one of the other commodities that's continuing to work is steel right here. SLX is the ETF for the commodity steel itself, also in an uptrend right there. So really those four. Wood had been moving higher, lumber having a little bit of a retracement here as well. So interesting that commodities are going to move higher in inflationary environments, and you're continuing to see money flow into those commodities. Now, in addition to that, there's going to be stocks that correspond to those commodities. So you're going to see energy stocks. You're going to see some of these stocks that are moving higher based on, that's an electric power, but based on oil. Arch Rock has been moving, AROC, oil and energy. Those are the trends moving higher. We're seeing, one of the things that's interesting right here over in the ETF group is uranium. So you've got junior uranium miners. Okay, these are all moving higher and getting a decent move. We did add a new trade into our portfolio today, which was Denison Mines. Okay, and so this was a really nice confirmation bar. So, and Denison Mines is a big uranium miner. Okay, so you're getting this confirmation move here. A bounce, a retracement, confirmation bar in the 236 momentum zone, and in that sector that is also starting to gain some momentum. Okay, so an interesting location right here for Denison. But if you're looking for, the hard thing sometimes is, well, and this has happened to us with some of these oil picks lately, is it's like, oh, that stock didn't move with oil. So you can sometimes get individual miners that don't participate. And if you want to make sure that you are participating, then you're going to buy them all. You can do that by owning an ETF, like something like this, like Uranium Miners ETF. If you were to go out and do a little homework on that and say, I'm not even sure where to go. Maybe let's just go out here to a bar chart and see if they have a list of, a lot of times they don't. A list of stocks. We can spend some time on that another time. Of all of the uranium stocks that are being included, obviously Denison's going to be one of them, but I think that this commodity play and uranium and energy and things that we're dealing with, it'll be interesting whether or not it pans out or not, but something to bring to your attention today. And I like to go through this muscle ETF scan from time to time just to get a quick eyeball of some of the other trends, that we've been talking about. We obviously know the current trends that we're dealing with. We're dealing with ultra short tech, so technology. Okay, let's take a look at some of these ultra shorts, these inverse ETFs, because there's some bonds in here as well. So let's look at ultra short technology. We got to split. These split all the time, and they're a real pain in the butt, honestly, for my data. But let's go through and what was the other one I was wanting to focus on, and that is oil and gas. So you're getting oil and gas direction. Gush is the symbol on that. And then also there's some inverse bonds. Let's see where it was at. Oh, right here. Ultra Pro short 20-year treasury, negative 3x. Let's explain what that is doing. Okay. So if we're looking at, so this is TTT. Let's go to TLT, which we've looked at. Okay, that's going down. So bonds are going down, and the inverse to that obviously is TTT, and it's going up in value. Okay, so as it drops, as TLT drops by 1%, this is going up by 3%. So essentially it's betting against, it's betting that bonds, as bonds are going down, that I'm going to be able to profit from this. It's an inverse ETF. It's doing the exact opposite of something else, whether it's a market or a commodity. This is one of the ways to be able to find those. And you're starting to see those because they're inverse and they're moving higher. They actually get stronger ranks. So you're going to see some of these starting to show up in this list that are inverse. Let's see if there's any others like this one right here. 7 to 10 Treasury Bear 3X Direction ETF. Same idea. It's moving higher as bonds are moving lower. Now, it's, whether or not it's a sustainable, significant type of investment, it certainly could be for a length of time, for a few months, but something long-term, probably not when it comes to those. They act more as hedges, and being able to take advantage of a shorter-term move against a downward trending market, or leverage to the upside. You can go with the market 3x as well. But inverse ETFs to be able to focus on. Now, let's take a look at a couple different ideas. Let's go to the new buy list. That was pretty thin here as well. You can see pretty lean when it came to the number of stocks that are in there. Let's look at NGL. So again, let's talk about entry and risk management here, just as a kind of a final note. Again, remember that a lot of times when we look at a chart, sometimes we look at this chart. I know I'm guilty of it, or have been in the past, and that is I think that because this price is way down here and this price is way up here, that we've missed the boat, right? It's like, oh man, I can't invest in this thing now or trade this thing now because it's already at the top of the chart and it was down here. I should have been buying it here and it's probably going to reverse. That, yes, that could happen as well. But remember what we're focused on. We're focused on this range of it continuing to move higher. Okay, really, in all honesty, we only need to focus on about this much of the chart right here, this high point, this 3236 level, and what the price is doing inside of that. All of this has already happened. Yes, that's great. Yes, it's moving higher, but the reality is we can enter into this and expect it to go higher, and then we manage our risk with a stop loss. So let's do that real quick. If I wanted to buy this stock, I would say let's add it to a portfolio. In this case, I typically use this 100,000 portfolio just as an example. I want to determine what are my number of shares here. So if I said, what's my risk? If I have $100,000 and I'm going to trade a certain amount for the wheel portfolio strategy that we utilize, we're going to do 2 to 2.5% of our capital that we're risking into each trade. So if I just put, I don't know, let's put $1,000 in here or 1,000 shares. So if I did 1,000 shares, that's a $6,000 trade. That's 5%, almost 6% of my portfolio that is at risk. That alone, because we don't have a stop loss, that alone is too high. Okay, so I want to lower that by managing my position size here. Let's bring that down. I obviously know I'm way too high by double, so let's cut that in half. 236 or 293, that's way too high still. I want to come down to 300 shares. Oops, 300. Now I'm at 1.76. That's a little low. I could go back up to 350. So there's 2% right here. Now this 2% is my amount at risk. Okay, and again, it's the full position size because I'm not showing my stop loss. This is the worst case scenario number. If something happened to this stock right here and it dropped to 0, we would lose $2,000 or 2% of our 100,000. That's the absolute worst case scenario. Is that going to happen? The probabilities of that happening on a stock is really, really small. Okay, companies just don't go to 0. Stocks don't go to 0 overnight unless there's something really, really crazy happening. But usually, even then, it's maybe a 2 or 3 day process. Something like Lehman Brothers or Bear Stearns back in the day, if you remember those, they collapsed within 3 or 4 days, and they did go bankrupt. And that's when a stock price goes to 0, is when a company goes bankrupt. Well, yeah, that's typically about the only time. And so we can start there. We can start with risk of what is the absolute worst case scenario, and would I be okay with it? If this stock dropped to 0, I'd be like, well, that's not fun, but I can still trade. It's not going to blow up an account. It's not going to set me back years. And that's one of the parameters when it comes to risk tolerance and understanding yourself and understanding how you deal with volatility and fluctuation is, man, how much volatility or risk could I actually deal with? Now, if I set a stop loss down below this low point, I usually like to use that 236 as an initial stop loss location. If a stock is in the momentum zone and getting confirmation here, in this case, I just randomly pull the stock up, so we can do that as well. May not be the ideal entry, but it's also not too bad. But now I've got to look at what's my risk on this trade. Let's go ahead and set a stop on this at exactly 560 and see what that does. So we'll go 560. Now I'm choosing a 560 stop loss here at my stop price, just because I like to go below this line right here. Now this Fibonacci line is connecting here. You click this box, it's connecting the high point and the low point, and then it draws these levels and gives us these levels. And if we get a pullback to this range and we start to get some support back in, typically you get a continuation trade out of that. With our stop at 560, that puts our risk at 0.17. That's $182 at risk, which is 8% of that trade. That's a good solid setup. We got a possible trade in an industry like oil that's moving higher. We've got a solid uptrend on a strong stock that is bouncing inside of the momentum zone, and we want to take a stab at it. Okay, if that's the case and I wanted to buy it today, then I could say, okay, if I'm wrong, I'm going to get stopped out. Stopped out meaning I'm going to set that stop price. It's automatically going to trigger and sell me out of that trade. The reason I want to do that, number one, is I want to protect this amount as much as possible, and I want to know what my risk is. Now, this is not always the full amount of risk, because we know that stocks can gap lower. You get an open and then an earnings report or an FDA or something. If it's a biotech stock, or we've seen it work on both directions to the upside as well. You get some kind of an approval or some kind, and you can get massive gaps to the upside. So the gaps are the gaps we can only control with the number of shares. That's why we have a little bit smaller position sizes, because if we had a big position and we dealt with a gap on some of the stocks that we're trading, these high momentum stocks that are really jumpy right here, there's significant risk to that. So we want to make sure that this is small. Make sure it's small anyway. Okay, till your comfort zone is really established. Trade smaller than you might think you're comfortable with. Trade, I don't know, trade one share if you have to, so that it's a completely meaningless when it comes to money, but it's very, very impactful to help you learn the process and help you actually execute trades. Make a live trade, do it over and over, and do it a lot. Do one share. If you're not comfortable yet, you don't have to jump right in. You're not going to miss out, especially if you don't know your brokerage platform yet and you screw up and make a decision that you end up, buying too many shares, or you didn't set your stop loss and it gapped lower and you feel some pain. Okay. That's frustrating. That's a learning curve that you want to get through without big money. Okay. Or even without real money. Use these simulators as long as you can until you're comfortable with it. There's always going to be opportunities, and you just want to make sure that you've been able to prepare yourself as much as possible. Okay, so let's so that really this is what I would be setting up for this trade. Now, what this allows me to do with this position size, it allows me to take a lot of trades, which we do. We usually take one trade every day at least, and so we're able to pick up a lot of opportunities, or have an opportunity to trade new things that may be moving while keeping our risk low as well. It's tough to pick which one of these stocks is going to be the one that really moves higher. Okay, and so we want to add as much probability of having one of these be a big winner as we possibly can. Now, case in point, this is what sometimes a little bit too much fear in management and in market conditions can do for a trade. And this is always hard because ALPN, so ALPN gapped higher. I think it had a buyout offer. I need to go double check it. But we bought it right here and it was moving higher, and it started to retrace back down here. And we sold some into some strength, got a smaller position. We ended up with a smaller position right around here. As it started to retrace and move lower, then we had a decision to make, right? And that is, okay, we've got a big winner, we've got some gains. It was sitting right, it was even before this bar, it was right here. And we had our stop loss set. In fact, it was right below this. It hadn't been stopped out, but it was looking like it was getting very close. And we'd said, well, let's just go ahead and reduce the risk based on the position that we have. Now, that typically we will do that in a market. This, like I said, the reason why is because the market conditions are way high. 22, that market bullish trend is at 22. So in order to reduce risk, we've got to do that in some ways. But this is why we buy these momentum stocks, is because we're going to get one or two or three, and we've had a couple of these. This one rallied higher, big move yesterday, overnight gap. So there was probably some insiders that knew this was coming and started to buy, got leaked, and then something happened here to that. So that was a massive move higher. We got a big chunk of it, but we missed out on a chunk of it here as well. So that upside, it's like we just really want to allow for a stock to have this possibility and have this option. And so we're going to get 3 or 4 big ones like this out of the year, where they're up a couple 100%, or maybe even more than that. But we want to be able to have enough cash and enough of these positions that we can take advantage of them when they get here. So still lots of opportunities. But that being said, I'm a pretty risk averse trader. And right now, in terms of this portfolio, I'm being quite conservative just because that is the prudent thing to do in terms of making it a sustainable process and not taking on too much risk and being okay and understanding what's sustainable, what's manageable, and what's doable. And in this case, we've outperformed the S&P still pretty significantly just in the last, since September was when we started this. And this year has been relatively flat, similar to the S&P 500 and markets as a whole. If we were to look at this, and then I'll finish up. Really from the beginning of the year, right around here, it just hasn't done a whole lot. Relatively flat, slight upside, maybe a few percentage points overall, but pretty nice trend as it's moving higher. Portfolio management and the wheel strategy in terms of the percentage allocated. If you're interested in joining me in the Discord room and going through these trades each morning, there's a link to the wheel portfolio in the footer of these, in the description of these videos, that you can learn a little bit more about that and access that if you're interested. In the webinars, I'm still going to talk about the stocks and talk about the portfolio as well. We just won't be managing them as effectively in this room as we do in the well, we don't manage in this room. We manage it in the Discord room. Anyway, that's for you to be able to decide on there as well. Let me just summarize here again. Market conditions, we're seeing that weakness. Even just this chart right here dealing with S&P 500. Watch the support areas, watch these color changes, and see if we continue to start to slide. If we can bounce and retest some of these support areas and move higher, we may get some follow through. But remember the weakness that is happening in sectors. We've got sector weakness across the board. So the only thing that may be holding up the S&P is still those handful of stocks that have been moving it higher anyway. And the rest of the market is starting to move lower, minus the commodities. Big rally in commodities, big sell-off in everything else, big sell-off on bonds. Interest rates are higher. Inflation is still hot. Okay, that is not real conducive to equities. It is very conducive to commodities. So keep an eye on commodities still. Keep an eye on these oil stocks, gold stocks, mining stocks, uranium stocks, steel producing stocks. Anything to do with a physical commodity is doing well and should continue to trend well also. I'm going to end on that note. I appreciate everyone's time and effort, and we'll see you next time. Have a fantastic weekend. Bye now.